If you have a checking account and you're over 60, there are 3 money rules you cannot afford to ignore anymore because the old shortcuts people used to trust are no longer enough to protect them. No letter showed up in the mail. No one from the bank sat you down and explained it. And most seniors still think the number to watch is $10,000, as if staying below that line keeps everything simple and invisible. It doesn't. Today, I'm going to walk you through the 3 checking account rules that matter most right now. The dollar amount that no longer gives you the protection you think it does. The completely ordinary banking habit that can start attracting the wrong kind of attention. And the family payment mistake that can snowball into tax trouble if it gets reported the wrong way. Stay with me all the way through, because the third one is the one that catches the most people off guard, especially seniors who are simply getting help from family and think that means nothing needs to be tracked. If this kind of information helps you protect what you've built and makes retirement easier to manage, make sure you're subscribed, because every week I break down the financial and legal changes that matter in plain English. And this one matters because none of these rules feel dangerous when you're living your normal life. That is exactly why they catch people late. Most of the time, the problem doesn't start with fraud, cheating, or anything criminal. It starts with outdated assumptions. It starts with a senior doing what they've always done. The same bank, the same account, the same habits, and not realizing the systems around them are now interpreting those habits differently than they used to. Let's start with rule number 1. The number most seniors were taught to respect was $10,000. For years, people repeated the same advice. Stay under $10,000 in cash and you stay off the radar. But that is an incomplete understanding of how reporting works. Under the Bank Secrecy Act, financial institutions are required to report cash transactions that exceed $10,000 in a single business day, including daily aggregated cash activity. That part is still true. But what many seniors miss is that the $10,000 line was never a privacy shield. It was only one reporting threshold. Banks are also required to watch for suspicious activity. And suspicious doesn't always mean huge. It can mean unusual. It can mean repetitive. It can mean a pattern that looks designed to avoid the very reporting rules people think they're cleverly staying beneath. That is why the safer way to think about this now is not, how do I stay under the number? The safer question is, would this pattern make sense to someone reviewing my account with no context? Because banks do not just look at single deposits or withdrawals in isolation. They look at frequency, timing, sequence, and behavior across your account history. And under federal rules, a bank must file a suspicious activity report when a transaction involves or aggregates at least $5,000 and appears tied to possible legal or regulatory violations. On top of that, the rules also allow a bank to file a report on suspicious activity even when the reporting is not strictly required. In plain English, that means smaller transactions can still become part of a file if the pattern itself raises concern. Now, here's where seniors get caught. A retiree might split up cash deposits because they don't want to hassle at the bank. Someone else may withdraw steady amounts for home repairs, caregiving help, or routine household expenses. Another person may move money in pieces between accounts because it feels safer, slower, and more controlled. None of those actions automatically mean wrongdoing. But to bank compliance software, context is missing. It sees repeated cash activity just below major thresholds, unusual changes in routine, or multiple connected transactions that do not match a customer's prior behavior. That is why the old idea that under $10,000 means you're fine can create a false sense of safety. The number is still real, but it is no longer the whole story. The pattern around the number is what matters. Rule number 2 is the one that scares people most because it turns a normal habit into a possible federal flag. Picture a widow who has handled her bills one way for years. Then life changes. Her spouse passes away, inflation keeps pushing everyday costs higher, and she starts taking out more cash every month because she's now paying every bill alone. From her point of view, nothing suspicious is happening. She is just adapting to retirement life. But from the bank's point of view, a long-standing account has changed behavior. The withdrawals are more frequent, the amounts are more regular, or the transaction timing suddenly becomes patterned in a new way. That is the kind of thing automated systems notice long before a human ever looks at the account. And this is the part most people never hear. If a suspicious activity report is filed, the bank generally cannot tell you. The report itself is confidential, and institutions are prohibited from disclosing that it exists. So a senior may continue banking as usual with no warning at all, unaware that their account activity has already been escalated internally. That silence is what makes this so dangerous. People think no news means no problem. In reality, no news may simply mean the system is doing exactly what it was built to do without alerting the customer. And because these rules apply across banks, credit unions, and other covered financial institutions, switching from a big national bank to a smaller local institution does not make the reporting framework disappear. So what do you do if you use cash regularly and you do not want ordinary activity misread? Documentation becomes your best protection. If you are withdrawing money for a caregiver, groceries, homework, church giving, travel, or family support, keep a simple written record. Date, amount, and purpose. That is enough. If you need to move a large amount between your own accounts, it is often cleaner to do one clearly documented transfer rather than several smaller, unexplained moves that create a messy trail. If your banking habits changed because of a life event like retirement, a death in the family, medical costs, or a move, make sure your own records tell that story clearly. The goal is not to become paranoid. The goal is to make your normal life legible if anyone ever asks questions later. Now let's get to rule number 3, and this is the one that hits families. A lot of seniors receive money from adult children, grandchildren, relatives, or close friends through payment apps. It may be help with groceries, prescriptions, rent, utilities, or replacing a broken appliance. To the family, it feels personal, private, and informal. But when money moves through a payment app or online marketplace, reporting rules can enter the picture if the payments are treated as payments for goods or services. Right now, the IRS says third-party settlement organizations like payment apps and online marketplaces are generally required to issue a Form 1099-K when payments for goods or services exceed $20,000 and more than 200 transactions. They may also send a form at lower amounts. That last sentence matters more than people think, because the issue is not only whether you were supposed to get a form. The issue is what happens if a form is generated, or if transactions are coded the wrong way, and the IRS computer system matches that information against your return. The IRS is clear that personal payments from family and friends, like gifts or reimbursements for personal expenses, should not be reported on a Form 1099-K and are not taxable income to the recipient. That is the good news. The bad news is that mistakes still happen. If family members send money through an app and mark it the wrong way, or if a platform reports activity that looks business-related, the mismatch can trigger follow-up. And when that happens, the notice many people receive is a CP2000. A CP2000 is not a bill and it is not an audit, but it is absolutely not something to ignore. It is a proposed adjustment based on information the IRS received from third parties that does not match what was reported on your tax return. That means if a senior gets family support through an app and a form shows up that makes those transfers look like income, the burden shifts quickly. You may have to explain what the money was, why it was sent, and why it should not be treated as taxable earnings. And if you simply toss the notice aside because you know the money was personal, the system does not automatically give you the benefit of that explanation. You have to respond by the date on the notice and provide support. This is where simple habits save enormous stress. If family sends you money, have them label it accurately inside the app whenever possible as personal, non-business, or reimbursement. Save screenshots. Keep a basic family transfer log with names, dates, amounts, and purpose. If the money was a true gift, remember that gift tax rules generally fall on the giver if reporting is ever required, not the recipient as ordinary income. And if you ever do receive a $1,099K that does not look right, do not panic and do not assume the IRS already understands the context. Pull your app history, compare it to the form, and answer fast. The IRS also says its normal assessment window is usually 3 years, but in certain major underreporting situations, that period can extend to 6 years. So problems do not always show up immediately. Here is the action plan I want you to follow. First, stop thinking only in terms of thresholds and start thinking in terms of patterns. Review your last few months of banking activity and ask whether an outsider could understand it without explanation. Second, if you use cash often, keep a written log from now on. Nothing fancy, just enough to explain where the money went or where it came from. Third, if you move money between your own accounts, make it clean, direct, and documented. Fourth, if family sends you support through an app, make sure those payments are labeled correctly and saved. Fifth, if a tax notice arrives, respond by the deadline listed on it, because silence never helps you. And sixth, if you know your transactions have become more complex over the last year, consider having a qualified tax professional review the paper trail before the IRS or your bank ever asks for one. None of this means you should be afraid to use your own money. It means you should stop relying on outdated advice that leaves out how modern reporting really works. The $10,000 line is not a magic shield. A normal habit can look suspicious if the context is missing. And family money is only harmless on paper if it is classified and documented the right way. That is why so many seniors find out too late. Not because they did something terrible, but because they did something ordinary inside a system that no longer runs on ordinary assumptions. The people who stay ahead of this are not the ones hiding money. They are the ones keeping clean records, understanding what gets reported, and refusing to wait until a notice shows up to start getting organized. Don't be the last to know.